It happened quietly, while you were asleep. While the headlines were still arguing about zero inflation. And while most people assumed the silver story could wait until Monday. But the system didn't wait. Because overnight, the market printed something that doesn't fit the comfortable two-decimal world you see on a New York screen. We got the Shanghai Gold Exchange close for Wednesday, January 14, 2026, and the number coming out of China isn't just a price. It's a receipt. It's the kind of receipt that exposes what the paper narrative has been trying to keep smooth. Here's the part that should make you sit up. This wasn't a leverage futures flicker. This wasn't a speculative headline move. This was cash. What real industrial buyers paid to lock down physical silver for immediate delivery. No, we'll settle later. No rollover gains. Just money on the table. Metal demanded now. And when the demand center of the world starts paying up in public, it changes what every other quote means. Because the question stops being, what does spot say? And becomes, where is the metal actually clearing today? For decades, silver has lived in a psychological box, double digits. Then maybe $20. Then maybe $50, always treated like it's common. Like it's optional. Like it can be printed on a screen forever. But markets don't care what feels normal. They care what clears. So before you scroll past another calm-looking chart, let me ask you one question that decides everything for the rest of this video. If China is paying a real premium for real metal, right now, who's still selling it at the cheaper number? And how long can that last before the entire pricing game resets? It happened while most of the West was asleep, and by the time your chart refreshed, the line had already been crossed. Not a headline line, a structural one, the kind you don't uncross. Go to the close. Don't look at the noise. Look at the print. The Shanghai Gold Exchange closing data from Wednesday, January 14, 2026. On the surface, it's just another number. 2 decimals. Clean. Forgettable. But if you've watched enough markets, you know the most dangerous signals don't arrive with sirens. They arrive like paperwork, stamped, filed, and quietly final. Because that close doesn't behave like normal volatility. Volatility is weather, random swings, mean reversion, traders arguing on TV. This was different. This read like an inflection point. Like the pricing regime itself taking a hit. The moment physical demand stops asking permission from paper narratives. The moment the reference price stops being the boss and starts being the excuse. Here's the uncomfortable question. If the real demand center is willing to pay up at the close, on record, in size, what does that say about the spot quote you've been trained to trust? What does it say about the system that needs leverage and roll games to keep the illusion smooth? This is why the close matters. It's not drama. It's a receipt. And receipts don't care about opinions. So before you check another Western screen, do this. Anchor on that Shanghai print. Because if that was the line in the sand, then everything that comes next isn't a move. It's the start of a reset. If the Shanghai close was the line in the sand, the next step is simple, and it's where most people get it wrong. They stare at the Western spot quote like it's the truth. 2 decimals, a clean little number that feels official. But that number is a reference, a headline,
the weight
a
distribution
story the
is
paper
uneven
system
on
can
this
keep
stack.
tidy. The real tell is the spread, the gap between what New York prints and what China pays for metal that has to show up now. Because Shanghai isn't bidding on a theory, it's bidding on delivery. Cash, immediate, no roll, no we'll settle later. No accounting tricks to smooth the tape. And when that benchmark sits roughly $11 plus per ounce above the Western reference, it's not a quirky regional difference. It's a stress signal. It's the market admitting, quietly, mechanically, that physical silver is scarce where it's actually needed. Ask yourself what that spread is really saying. If industrial buyers in the world's largest manufacturing engine are paying up, today, at the close, what does that imply about the silver behind the Western quote? Not the contracts, not the promises, the metal. This is the moment your spot price stops being a price and starts being a lagging indicator. A number that can stay calm while the real world tightens. And that's why the spread matters more than the headline chart. It's the first place the system's 2 realities can't hide from each other. So here's the curiosity hook that should bother you. When the demand center is paying a double-digit premium for immediate delivery, Who exactly is still selling silver at the cheaper number, and how long can that last before the flow reverses violently? That spread doesn't just describe stress, it creates a machine. And once it's wide enough, the machine turns on by itself. Because when Shanghai is paying materially more than New York, arbitrage stops being a strategy and becomes a reflex. Not for retail. For the players with pipelines, traders, refiners, logistics desks, institutions who don't care about your spot quote. They care about where the bid is real and where metal can actually clear at the highest price. Here's how it works in plain terms. If the West is still referencing a cheaper paper-based number, you can source metal flows tied to that pricing, contracts, allocations, supply agreements, then move the physical toward the demand center that's paying up. It doesn't require a conspiracy. It requires a calculator, a freight quote, and a phone call. And that's when the spread becomes gravity. Metal doesn't debate where to go. It migrates toward the premium the way water runs downhill. The moment that path opens, it starts acting like a one-way valve. Supply gets pulled east. And the system in the West is left trying to do something paper is terrible at, matching a physical vacuum with financial paperwork. This is the part most people miss. Arbitrage isn't neutral when inventories are thin. It's a vacuum cleaner. The wider the gap, the harder it pulls. And the harder it pulls, the faster the visible symptoms show up. Inventory drains. Delivery windows stretch. Availability turns into backorder. And the paper market starts to feel like it's quoting a product it can't reliably source on schedule. So ask the uncomfortable question that follows your spread chart. If the premium is the gravity field, how long before the paper price is forced to chase the physical, rather than the other way around? When arbitrage turns into a vacuum, the paper system doesn't argue back. It adapts. And the fastest adapters in the room aren't the retail crowd, they're the bullion banks. Here's the twist the script leans on. Banks aren't ideological. They don't wake up believing in suppression or fair pricing. They wake up believing in one thing: survival through positioning. If leaning on price works, they lean. If the floor starts cracking, they don't hold the line out of pride. They flip. That's why the narrative treats stress territory, levels like $85, as more than a chart milestone. It's a risk threshold. At that point, short exposure stops being managed and starts being toxic. Because delivery uncertainty creeps in, your hedges assume liquidity, your models assume you can source metal. But when the physical pull is rising and the spread is acting like gravity, those assumptions get expensive fast. And this is where the market changes character. The banks that used to press down don't just stop pressing. They begin to buy, first to cover, then to hedge, then to front-run the next problem. In other words, yesterday's suppressors become today's accelerants. Not because they've joined your team, but because the math forced a pivot. If you want a clean mental picture, it's this. A fire breaks out in a building, and the people who designed the sprinklers are suddenly sprinting for the exits. That spread is what you see as momentum. So here's the curiosity hook that matters. If the biggest, most liquid actors can flip in a weekend, quietly, mechanically, how do you think the tape looks when the crowd realizes the banks aren't defending the old price anymore? They're repositioning for what comes after it. Once the banks flip, the market stops being a quiet chess match and starts becoming something messier, something human. Because institutional flows can move price. But psychology is what turns a move into a stampede.
The inbound volume is up by 10% compared
This is where
to
the
this time
script
last
introduces
quarter.
the behavioral
We need to
trap,
adjust the staffing
unit
levels
bias.
for the evening shift to
People
handle the
don't
flow.
evaluate silver like a spreadsheet. They evaluate it like a story. As long as the price feels manageable, the metal feels common, another commodity, another ticker, another hobby. But cross certain psychological digits and the brain reclassifies it instantly, not as but as scarce. And that's why the Shanghai premium shock matters beyond the spread chart. It doesn't just signal tightness to professionals, it broadcasts scarcity to everyone else. It tells the mainstream, in one blunt implication, if China is paying up for immediate delivery, then the metal isn't where you think it is. That's not a technical message. That's a dinner table message. Then the gold rush loop kicks in. Headlines chase the move. The move attracts new buyers. New buyers drain what's left on shelves. And the visible scarcity pushes premiums higher, which makes the story louder. which pulls in the next wave. It's a feedback loop where the catalyst isn't a tweet. It's availability. The brutal irony is timing. Retail participation arrives when the supply chain is already tight and institutional players are already repositioning. That means the public doesn't join early. They join right when the system's buffer is thinnest, when every extra ounce demanded has to come from somewhere real. So here's the